What's going up, guys? Welcome back to the channel. It's your boy Octavio Options back again with another YouTube video, guys. And today, guys, it's gonna be kind of a different type of video, but we're gonna be diving into buying low and sell high for calls, and buy high and sell low for puts. And this is for the people who just wanna start getting into this and start learning how to trade options. This is a great video for y'all to start learning the bottom or the beginning, how to process on buy low, sell high for calls, and buy high for and sell low for puts, basically. And we're gonna be going into this in depth, guys, and then we're gonna be hopping into some charts, and I'm gonna be just showing y'all some gradually just light examples where your brain can just kind of start seeing this and start seeing this, like where to buy, or like start seeing the little patterns within the charts, on like finding your support, you know what I mean? Because like I know some people just look at the charts and like, what do I look at, where like where it's, you know what I mean? So let's get into this, guys. I'm gonna read y'all this guide, and this guide is down below on my course, on my free course, as well with a ton of more free stuff, guys. Alrighty, so buy low, sell high calls, buy high, sell low for puts. Okay, so what you want to think about this is buying low and collecting that premium to that high, and selling at that high to collect that premium where that you bought that low, and you're selling at that high and you're collecting that low to that high premium. Just think about it like that. And then for puts, you'll be buying at the high and selling at the low. You'll be collecting the whole premium down and buying selling at the low. You'll be at the high, you buy at the high, you sell at the low. That's for puts, right? And you collect the whatever spacing is in between of premium. Just think about it like that. Okay. Buy low, sell high for calls, right? Why buy low? Buy low, sell high for calls. Excuse me. Why buy call options, right? So you have the right to buy underlying assets at the price regardless of how much the price of the asset rises above the strike price. So, um, let's say I want to buy a call for right now. The strike price right now, JP Morgan, guys. Remember, look at JP Morgan. It's at almost at $200. We're at 199. So let's say I think this is gonna go back up to 204, back to this gap up. So I'd be buying a call. I'd be buying a call at 200 strike. Let me see. Go 5 minutes. I'd be buying a strike at the 200, exactly at this line, where this purple line is at. That's my strike price. So I would collect wherever I bought it from. Let's say the market opens here at that. Let's say the market opens here at this red line. Let's just blue line, whatever. Oh, market opens here, right? And I want to buy a call option, right? To the 200 strike, right? So say the market goes up from 199 all the way to 204. So I would have collected the 200 strike in between 200 all the way to 204 premium. So I'd be collecting this whole premium right here, guys. Just pretend like the market's going up, and like we're going back to 200 to 204. You know what I mean? So I'll be buying the 200 strike at the low, be expecting us to push up higher than this 200 to go up to this high up here, and I'll be collecting that 200, all that in between from 200 all the way to 204, and that's the premium. I would sell at the 204s. So you'll buy at the 200 at whatever confluence, break a structure, liquidity sweep, whatever you want to call it. You'd buy that at the lows for that call. You'll buy it to 200, and you'll ride that to 204, and you'll sell at that premium at 204, right? Are y'all kind of getting me? So you're kind of riding the chart for that premium of that underlying strike. So let's do another little example. Let's delete this here. Let's go here when we're in a little right here. This is perfect right here. So say the market opened at this high right here. Right here at 198. Pretend like this is not here. So we opened right here at 198, and I buy a strike at 200s. So I buy a strike right at open. I get filled. Boom. Market opens. And I see the market going up. Oh, boom. Look. We're above 200s now. So I would have collected that from wherever I bought it from to that 200 strike. And if I want to keep holding to even ride that longer to the upside, you can. But that's up to you. And that's like your confluences. And that's within like market analysis and reading the chart. But you can see that we went above that 200 strike. And now you should be like you riding the money now. You're riding this, all these candles between here from this 200 to this up here wherever you want to sell it. You're riding that premium, or from wherever you bought it. Say you bought it at open down here. You're riding that 200. We break that 200. Oh, that's more confluence. We're holding. Oh, it's a 205 or whatever the next target is. But you're collecting that premium. And what I'm trying to make you understand is you buy that asset at the low, expecting that strike to for cause is to go up, right? So you buy that underlying strike, and you expect the market to go up, and you'll be collecting that the margin between that your strike price and wherever your take profit is. You know what I mean? That's just to get into the cause, right? So you would have made all this bread right here from 200 all the way to 205 because, you know, that's the high right here. Okay? So the profit potentially increases as the price of the underlying asset rises above the strike price of the call option. That's what I was talking about. You buy the 200, you see the market go above the 200 above your strike prices. That's when you get into the real premium. You're riding that shit now. You're in the money. You're collecting that shit, and that's when you ride that shit, right? Buying low, selling high with calls. Buy low. The concept of buying low in trading calls refers to purchasing call option when the price of the underlying asset is relatively low compared to where you expected it to rise in the future. You know what I'm saying? I'll reread that to y'all again. Buy low. The concept of buying low in trading calls refers to purchasing call option when the price of underlying assets is relative low compared to where the where you expect it to rise into the future. So that's what I'm saying. That's where you're taking your TP. Is you're buying that the underlying you're buying that call option for that underlying asset, and you expecting it for it to push up higher and collecting that premium. You know what I mean? And selling high, similar, is that selling high means selling the call option when the price of the underlying asset, that means you're underlying it, you're under the asset, you're in the money already. Underlying asset has risen to a profitable level relative to the strike price and premium paid. That's either your strike price, like you said, where you think the market was going to go, you take TP, or that premium paid, whereas you keep holding above that premium strike of your strike that you bought. Right? So, buy low. Definition. Buy low. This strategy involves purchasing call options when the price of the underlying asset is perceived as to be undervalued or at the lower point relative is to its potential future price increase. Right? Rationale. Traders aim to capitalize on opportunities where the current market price of underlying asset does not fully reflect its expected future value. By buying call options at a lower price point, traders positions themselves to a profit from anticipated upward movement in the asset's price. That's you buying low and you anticipating for an upward move for that whatever stock you're buying for it to go up to your strike price, right? And implementations. Market analysis conducts through technical and fundamental analysis to identify assets that are clearly undervalued or have potential catalysts for a price appreciation. Yeah, y'all gotta understand that. Strike price selection. Choose the strike price for the call option that is slightly above the current market price as the asset ensures profitability if the asset's price risen above that strike price by expiration. Right? That's you buying the asset, you thinking aka that stock is gonna go up higher. You buying that exact strike, that where you think that market's gonna go up higher, and you're collecting that premium, right, guys? So, example scenario: current stock market price X, Y, and Z is trading at $50 per share, right? Market analysis based off analysis is anticipated company X, Y, and Z stock price will increase significantly due to upcoming positive earnings, right? So let's say that. Call option purchases: you buy one call option at a price at 55, strike price at 55, and expiration of 2 months out, $2 per share. So that's 200 per share, guys. $200 per one call, one contract for your call option is $200. So, okay, let's get that concept. So your total cost is 200 for one contract, exactly. Outcome: if company X, Y, and Z stock rises to $60, that's 55 to $60. That is a $5 gap, or like $5 that the market went up. By expiration, you can exercise these call options, buying the shares at the 55 strike price instead of the market price of 60. That's resulting in a profit of $3. $3 per share. $60 market price, 55 strike price, $2 premium paid. Boom! Easy money, in and out, boys. You know what I'm saying? So, now you gotta sell at the highs. You gotta sell at the highs, and you gotta take your profits, guys. You don't want to be writing that call option and it to go go up and down, and it to end up coming back down to your strike price, and you don't collect nothing. So sell at the high. Definition: selling at the high. The strategy involves selling the call option when the price's underlying asset has risen to a profitable level relative to the strike price as premium paid for the option. Right, guys? So, after purchasing a call option, at a lower price point, expecting a favorable increase in that underlying asset to go higher, traders may choose to realize their gains by selling the call option at a higher price. That's you taking profit at those highs, guys. And this is kind of like an example right here that I put for y'all. And then technical points: timing and analysis, emphasizing the importance of conducting through market analysis and timing and entry and exit point are effectively. You gotta set your entry and your exit, a finish line, a start and a finish line. You know what I'm saying? You start the race here and you finish the line up here. But you have to make sure you finish. That's taking profit. Risk management. Discuss trading strategies to manage risk associated with option tradings, including setting stop loss orders, or and implementing profit taking measures. That's setting a stop loss, little 1 to 2. You know what I'm saying? Reward experiences, reward examples. Use cases studies that participate in examples that illustrate successful applications of buying low and selling high strategies in the call options. Right, guys, and this is kind of like example right here. At the green is where you buy, and at the red is where you sell. You see, once we broke above this red, we turn into this buy, because sell side, we broke that. Sell side turns into buy side, and sell side turns into support. You see that? And when we buy right here now, you buy low right here, you will sell at these highs until we break above that high and use that as support. Now you buy down here and sell at the next level high, etc., etc. Excuse me. Right, guys? So let's go into I already showed you an example for the calls for the 200 on JP Morgan. So I'm gonna show you like a little example right here I'm gonna be looking at for this coming up week for the call options for a little scalp to the upside on JP Morgan, if you want to take these. So we got this support right here, guys, at the daily. See where we're bouncing off of? The daily support. Look at the 4-hour. 200 EMA is my red line. And look, we're bouncing right at the point of control with breaking structure under this previous low. How do we know that? Is because we got a candle close under this previous low on the 1 minute. It might have looked like we respected on the 4 hours, because look at the 4 hours. See that? Let's go back up to the 1 minute and let's see if we respected that low. Look at this. Inefficiency, structural break, guys. Candle close under this previous low. This is all structural break now. So whatever we're coming up to right now is, that's just telling me we're sweeping those highs to push down lower. So that's what I'm thinking is going to come up Monday at right at market open. We sweep highs and we push down lower. So you can see we kind of found our support right here at the same spot where we did right here. So we can possibly push up back into these lows that we broke of this previous structure to this downside move right here at 202. You can see that if Monday morning opens and we get a continuation move up, push down, we get a breaker structure of this 15-minute 200, you can enter this 200 call options and continue this moving back up until we touch this high. Until we touch this low. Until we go into this low equilibrium within this high. And you can take profit up here within this 202 area. So you'll be setting up your win to reward ratio something like this. If we break this level, wrong one. If we break this level, you can tell yourself, okay, Octavio, if we break this level, if we break these two highs, we're going to go see 202s. Just because you know that, because that's just the previous highs where we got sold off. Look at the hourly. Where's the hourly sellers at? Sellers are sitting at the highs, guys. Sellers are at the highs up here. See that? We probably just have to look where we at. Look at this candle. See that? Probably want to sweep up here first. Like I said, sweep these highs, get a double top here, and push down lower. Why do we know that this is going to push down lower? Because we already got a lower structure break within this low. We got a candle close under this low. So this low is going to trigger this next low. If we break under this low, we're going to trigger this next low, etc., etc. So with whatever highs Monday gives us, I'm going to see a double top. Whatever kind of rejection I need to see off of these highs to go short and follow the trend. I'm going to be expecting us to touch this orb at least. To come down lower, and you can be writing something like this back to this. You know what I mean? Just because you know whatever we're going to sweep up back here is just that sweep of liquidity. It's just a push down lower. Why? Because we broke lower down here. You know what I'm trying to say here? And then for this thing stinks, say we push up, right? Monday. If you rode those calls, you made money from 200 to 204, right? And you see a double top. You see a double top now on Monday afternoon, right? Okay, that's a bit too much. You see a little double top right here start forming. And once we exit out of this line, you can take puts back to the downside. Just to retrace this shit down lower. Just because, you know, like I said, you know this is going to go down lower because of this breaker structure down here. You know what I'm trying to say here? We're just coming down here to get that double top on the hourly. See that? We can just come back up to this and just fully reject. That's what I'm expecting, guys, for this week. And then that's when we take out these lows, this 189, this upcoming week. That's for your cause, right, guys? That's an example. I hope you understand me there. And then you can ride this premium back down low, just because we know these puts are gonna be good when we get rejected off this highs. But you can take a little scalp, like I said, after breaking this 200s to the upside. Like just a little quick in and out, in and out, in and out. Cause guys, you do not want to be buying like against the trend. Your trend is your friend. See what I'm saying? But yes, guys, that's for cause. Now, buying puts, understanding the put option, guys. Buying under the asset and expecting the asset to go lower than your strike price, collecting that premium. You know what I'm saying, guys? So, put options give the buyer the right, but not the obligation to sell a specific qualified or underlying asset as the predetermined price strike price within a specific period until expiration. Traders buy put options when they believe the price of the underlying asset will decline significantly or just go down for a little bit during the option lifespan. Excuse me. Alrighty. Why buy put options? Profits from price declines. The primary objective of buying put options is to profit from a decline in the price of underlying assets when you're buying a put option. So that's buying high and selling low now. So we're buying at the high thinking that the underlying asset, aka that stock, is going to go down lower. So we're buying at the high. We buy those high strikes. It's puts, guys. We're buying puts, no calls. We're not buying low to sell high. We're buying high to sell low. It's puts, right? You have the right to sell the underlying asset at the strike price regardless of how much the price of the asset drops below the strike price. Same thing, like it's just the other way around basically. The potential increase of the price of the underlying asset decreases below the strike price of the put auction. Excuse me. Hedging against downside risk, investors and traders use put options to hedge against potential losses in their stock option portfolio. By purchasing put options, they can protect their investments by downside risk in the market moves against them. That's saying if you like you're thinking the market goes up and you buy a put. I mean, you think the market's gonna go down and you buy a put and you're gonna be writing that down. You know what I mean? That's hedging against downtrend risk. How it works. Market outlook. Before buying a put option, traders conduct analysis to determine the underlying asset is likely to decrease into that price. The analysis can include technical analysis, charting patterns, indicators, and fundamental analysis, company finance, and market trends. Strike price selection. That's you choosing the strike price that you're gonna buy, or that you're gonna like buy to sell, or buy. Yeah, basically. Try to select the strike price based on the forecast of the asset's price movement. So if you're thinking the price is that stock is gonna go up, okay, you're gonna look for a cause. If you think of that underlying asset is gonna go down under, you're gonna be puts. Typical, they choose a strike price below the current price of the asset to ensure profitability in their asset of their asset declines. Expiration dates. Put options have an expiration date beyond which their options expire worthless if the asset's price doesn't fall below the strike price, right? Traders consider the time frame within which they expect the price decline to occur when selecting the expiration date. That's what you selecting the expiration date before like buying it. Risk management. Profitable potential. From profit from buying a put option is the difference between the strike price and the lowest price of the underlying asset at expiration. The premium paid for the option. So that's you like riding at the high, thinking the market's gonna go down lower, so you're riding the highs to the lows. You know what I mean? You're collecting that all in between premium from that shit dropping. Risk management. Traders manage risk by limiting the amount they are willing to lose on a trade. That's your stop loss, or how much whatever you can lose within your account that day. 2 trades, 1 day, 1 trade, whatever it is. Typically setting a stop loss order or sizing their position appropriately relative to their overall portfolio. Exactly. That's what you want to do. Okay. Example scenario. We kind of already we're not gonna go into this. We're gonna go into a JP Morgan scenario, and then we're gonna come back into reading this key points of understanding of timing of entry and all that shit, because it is so important. So let's say the market. Let's just pretend like the market came from down here all the way back up here, and now we're sitting at this orb and we're at this big black candle at open, and you're thinking the market's gonna go back down to these lows. So you can buy right here from 209. Let's say right here we open the market at exactly 203, and say you want to buy a put option because you think we're gonna retrace this all back down to 197 from where we came from, right? So you are thinking the market is going to go from 203 all the way down to 197, right? That's essentially where you're going to be putting like your strike price and where you're going to be entering and exiting from. So that's a whole $6, $7 move down. You see that? So at exactly this point, I want to buy a put because I think the market's going to go down. Say you buy a 202 put, right? You buy a 202 put and you let the market do its thing, waiting for it to break down under your strike price, for you can buy that 202 all the way down to 197 because that's where the low of that day was, right? So you'd be buying like that. So you'd be buying that 202 and you'd be riding that 202 all the way down to 196 premium. You know what I'm trying to say? So you'd be collecting this whole premium right here, this whole down sweep premium. And you can see like we went to go touch that orb again and we just sold off. See that? So essentially you could have gone short up here like you did off of this orb. Say you did. Stop loss like that. Say your stop loss above this support. There you go. And then your target all the way down here at these red lows, because, you know, pretend like we came off of these lows. And look at that, guys. Your shit just starts printing down. And then this is the premium you collect, guys. Oh, shit. Because, there you go. This is the premium you collect. This whole, like, while the market is moving down, that's where you're collecting. It goes under your strike price now. Now you're in the premium. Now you're collecting the bread. You see that? And now you're really fucking printing now. And you could have sold down here at the lows. That's buying puts, and that's buying calls, guys. Right? Make sure to join the Discord, guys. So many free stuff here, guys. Chart analysis. People be posting their profits. Members be making 800% on QQQ puts. We got people making 76% on the portfolio. Over 400% on the portfolio. You know, we hit this QQQ puts on 01. We got people hitting fucking crazy numbers, guys. It's consistency. NVIDIA puts. We're fucking printing out here. Look at this. All in Discord, guys. We're live trading every single day, guys. For the free education, have this full of free education, guys. Same thing for option trading, full of free education. We have a Whoop link on my Discord. It's free course, and it goes through option trading and all that good stuff. Let me go ahead and show y'all. This is my Whoop link. We go here into it. We got 27 members into it right now. But look at this. We go through what's option trading, what it takes, what you need to know, and what you need to work on. Risk management and mastering psychology. Key option factors you need to know about charting. About options. Chart analysis, parting, and support. And then I did a little challenge. My blueprint that I'm using for this $200 to $1,000 to a $10,000 challenge. And then I have a free indicator y'all guys can use. It's right here. You just click the link. And it's my indicator I've been using for over 3 years of trading. And it's what I'm using right now. It's what you can see. This is an orb right here. This is the EMA orb, 50 and the 20. And you got the 200 right here. Once these both cross, that's a confluence to the downside. And we are in downtrend. And you can see once we cross, we absolutely murdered and just rode the EMAs. Look at that shit. See that? Riding the EMAs. Nothing but beautiful, guys. Same thing for the upside. Look. We crossed. My 200 and my EMA orbs crossed. And we're at a bullish trend. Look at that. Bullish trend. You ride EMAs. But this is 15 minute. This is showing you a big trend, guys. Like this EMA and this indicator is like so precise, guys. Alright. But I believe that's it for this video. I lied. Because we got key point understandings. Timing of entry. High price buying put options when underlying asset price is higher means you are entering at the trade. You're entering the trade at the point where you believe the asset's value is likely to decrease. This position you to profit from this anticipated price decline. Profit from price decline. The profitability of buying put options hinges on the underlying asset's price falling below the strike price of the put option by expiration. The larger the decline below the strike price, the greater your potential profit is. Right, guys? Strike price consideration. When selecting the strike price of a put option, traders typically choose a level below the current market price of the asset to ensure that if the asset prices drop as anticipated, the put option will become profitable. Exactly. That's 1 and 1. Make 2. Successful trading of put options requires conducting through market analysis of to identify potential catalysts or factors that could lead the decline in the asset price. This analysis can be based on technical indicators, fundamental factors such as earnings reports or economic data, or combination of both. Exactly. And then this we already went through an example, and then we can go through the conclusion. Buying put option when the price of underlying asset is higher. Therefore, before it's potentially decreased, with the strategy of anticipating and profiting for the decline prices, this approach requires a well-reasoned market analysis and an underlining of dynamics affecting the price of the asset movement. By timing your entry effectively and selecting or appreciated strike prices, you can position yourself to capitalize on downtrend prices movements. Amen to that, baby. Let's get it. Let's go. So, guys, that was your buying loan. So, little kind of snedgy bedgy video for y'all guys on if you're trying to learn how to trade options. You know, join the family, guys. We have almost 100 members in the Discord. It's down below, guys. Please, 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 please go join. And we got a literally free course for y'all. A free option course. Like I said, it's all up to y'all if y'all want this or not. It's all free. And right now, I'm working on a beginner's guide for option trading for y'all guys. So thank y'all so much for watching, guys. Thank y'all for everything, and yeah, guys, I'm very thankful for y'all. And remember, stick to your rules, stick to your plan. If you have a plan, stick to it. If you don't have a plan, create a plan and take action. Level up. It's time. It's time to get up, and it's time to wake up. All right, guys. So make sure y'all like and subscribe, guys. Thank y'all so much for watching, and peace out.